Hello, everyone. My name is Bakir, and today we have two very special guests with us. We have Mandeep and we have Gagan from GM Finance. And firstly, I would like to thank both of you for taking out the time to have this discussion. Broadly speaking, we will cover topics from general questions to talking about mortgages, investment properties, and how someone can look into buying one and how the role of a mortgage broker comes into play. And then we will end this with some closing questions. Gagan and Mandeep, they have a combined experience of more than 20 years working within the banking sector. They've worked with banks such as ASB, BNZ, and they would have some really good insights which we can all benefit from. So would you like to start off with a brief intro about yourself?
Good afternoon, everyone. First of all, thank you, Bakir, for arranging this and giving us the opportunity to talk about us. My name is Gagan Jatana. I am a financial advisor and co-director of GM Finance. So we started this company at the end of 2023. And before that, we both worked at banks. I started my banking career with BNZ in 2012. So I was at BNZ from 2012 to 2021, and then I spent around 2 years at ESB. Over that 11, 12 years, I worked primarily in home, business, commercial lending. So at GM Finance, we specialize in home loans, business loans, commercial, and asset finance.
Thank you. Mandeep ji.
Cool. Hi, everyone. As you've been saying my name all the time, so I'm Mandeep from GM Finance. We are registered financial advisors. So I started my journey with banks almost 8 or 9 years ago as a customer solution advisor, where we just like opening the accounts and sorting out general problems. And then within the 6 months, I became specialized becoming a banking advisor, where we are actually starting working in a home loan sector. And within a year, I went into a business banking sector where the ideas flows, and I started learning more exposures about the banks and stayed there as a business banking role almost 5 years, where I learned a heap of knowledge. And then, as Gaga mentioned, last year, we decided to come on our own. The reason simply is because we can see there's heaps of needs outside in the market, and educational stuff is the key part, where banks are obviously playing their main role. But I think a unique or the crucial part is the educational piece, where most of the clients they are missing. So we had our focus on that to give that education piece to clients, where they know what they are going for and the implications towards that. And I think that has been successful so far.
Oh, I absolutely agree. When you mentioned the education part, I see this. I think this is a very common and a big gap in the market here, where banks are doing what they're doing, but for the general population out there, whether it's some of the tax stuff we do, when it comes to loans, there is a big piece of lack of awareness in education, and I think this is what we're trying to also achieve from this discussion. So thank you for the wonderful intro. So if you allow me, let's just dive into some of the common questions, and I'm sure you get asked all the time. And let's start off with a bit of overview and with the current market update, right? There's a lot of talk going on right now on interest rates these days, and there's a lot happening. And I would like to, Gaganji, if you could give me sort of what your thoughts are in terms of what's happening with interest rates in general, and what does that mean for property owners or those who are looking to buy a property in the near future?
Yeah, no, definitely. Thank you. That's a very good question, actually, to start with. So in terms of the interest rates, definitely what we have seen, like all the others, is there have been some recent drops in OCRs, which actually is a positive sign for the market. What it means is that the drop in OCRs, banks' fixed rates have dropped, banks' test rates have dropped. So basic and simple language, what it means is that people can actually borrow more. With the decrease in interest rates, obviously it is beneficial for all of the mortgage holders. Their repayments are down. They actually have got some more funds available in their account, which they can use for their personal purposes. But from lending point of view, these things are interlinked. Drop in OCRs means that there will be a bit more activity in the market. We were having discussion with our real estate friends, and they are seeing a bit more positive response from the clients who are looking to buy property, whether it's the first homes or whether they are looking for investment properties. The foot traffic in open homes is more. When we talk about the test rates, with the drop in OCR rates, all the banks, all the lenders have actually dropped their test rates. What it means is that with the same income, now the way banks do their calculations, or the way we calculate clients' affordability or serviceability, they can borrow more with the same income compared to what it was about 3 months ago.
Okay, so if I understand that correctly, what you're saying is with the OCR going down, and I would like you to, Gaganji, also maybe just explain what does OCR stand for and what does it mean. But what I understand is with the OCR going down, with the same level of income, you can potentially borrow more. Is that right?
Yeah, that's right. Yeah, official cash rate. that's set up.
Official cash.
Yeah, of OCR. That's basically OCR stands for official cash right here.
Okay, brilliant. Thank you. Mandeepji, what are your thoughts on what's happening with the interest rates, and specifically also, how do you see this playing out over the next few months?
Yes, Bakaji, as Gagan explained, OCR stands for official cash rate. So that's the rate from where banks borrow money from Reserve Bank, and then they put their extra margin on top in order to give it to consumers. So that's how interest rates are being used or applied on mortgage or personal lendings. Now, obviously, we have seen from recent news, most of the analysts, economists, they are saying that inflation is under control. Hence, the OCR has been dropped. That means the interest rates has been dropped. But we need to look at the overall world pictures, what's happening out there. It's not just New Zealand got a really tiny economy as compared to US or UK market. So yes, interest rates are definitely dropping, but how long it's going to happen? So that's another question which normally comes with that interest rates are dropping, and is it gonna be continuous? No, it's not. So if I would say or justify this in just few lines, that means yes, interest rates are going down, test rates are going down. That means you have more borrowing power than before, than last year. So this is a really good time right now to buy a property or invest in something. Okay, because most of the analysts, they are predicting or analyzing that the next 3 years is going to be similar, and it's going to go steady. It's not going to be what used to be a couple of years or 3 years ago, like 2% or 3%. It's not going to be like that anymore. However, because there is still inflation out there, which most of the banks are trying to knuckle it down. So we hope, as all the advisors, that it stays like that. Um, but yeah, economy still needs to grow because the growth has been steady for a while, but still needs to grow. That's why banks are basically giving more borrowing power to the clients so they can borrow more money and the money circulates around the country. So the people will feed and more jobs are created, more businesses are created because of that. So the economy can grow. So that's how I see it. And one of the common platform which I'd like to address through your media, is that if anyone is really interested to read this kind of stuff, please visit. It's a public platform, interest.co.nz. There's heaps of information there, what's going to happen and what is currently happening and what future will bring to you. It's a really good platform, and I generally read that. It gives us a lot of information.
Brilliant. Thank you for sharing the website. And also, my takeaway from that was the good time to buy property, good time to invest, because interest rates are lower than what they were, say, in the recent past, and they're expected to go down further, if not be steady at the very least. And we might not go back to, I think you mentioned this, to COVID times when they were 2-3%.
Yeah.
And I think that was really a very unique situation. But I remember, or at least what I've read, is interest rates were as high as, it was very common for the interest rates to be double digits at some point in the past, right? So we're well below double digits there.
Yeah.
Okay, let me ask my next question then here, which is diving into a very good segue into, so someone who is then looking to buy property then, they're often confused. What I mean by that is there's a common question that comes up is, should they go for a pre-approval from the bank first, or should they search for the property first? And so what are the differences in these approaches, and which one would you recommend? Let's start off with you first, Mandeepji, for this, and then we'll go on to Gaganji.
Okay, thank you, Bakaji. There is currently two variations happening right now. So there are a few banks obviously giving pre-approvals, but most of the main banks, when I say, they are not keen to give pre-approvals because it's a quite busy period out there, and they're trying to use their resources for quality work, which means they like to see if there is actually a deal happening in the background. So they are looking more like a live sort of deals, that if customer has already found a property, put an agreement or a sale and purchase agreement in place, and hence they are looking to work on it rather than just using that banker or their resources just to provide a pre-approval to a client and just hold the money for someone to wait until they come back with their choice. So these are two different things currently happening in the market, but mainly focused over 60%, or I would say 70% of lenders, they are doing mainly live deals at this stage. So pre-approval, it's happening, but it's not really happening in the background because of the busy period, to be honest.
Interesting. Okay. So Gaganji, what are your thoughts? So if pre-approvals are then not happening, then what would be a good approach then in that case? Do you look for the property first and then approach a mortgage advisor? In terms of practical strategies, what would you suggest there then?
Yeah. Again, Mandeep's covered it really well, especially when it comes down to first-home buyers who are looking to buy property with less than 20% deposit. So there is no pre-approval. None of the lenders are doing the pre-approvals at all. And the best option for the clients who have got less than 20% deposit or they're buying a first home is to get in touch with the mortgage advisors, whether it's us or they've already got a relationship with someone. So the mortgage advisors, what we can do is because we have got using our experience, because we deal with all the banks, so we have got access to all the bank calculators. We can work out a figure. We can give them based upon obviously how much they can afford. We have to do a full assessment, and then we'll give them a figure that look based upon your income, deposit, etc., etc., etc. You should be able to get a loan for say $700,000. Then what our clients do is they know the figures, they know their deposit, they go out and then they look for a property in the same range. Once they find a property, we suggest them to make an offer subject to finance. Then it becomes a live deal because we have already got their documents, we have done the work for them. Then we basically have to update the request from our end and we submit it to the bank. So we always suggest our clients to make an offer subject to finance 10 business days. Remember, with first home buyers less than 20% deposit, there's a requirement from banks that they need a registered valuation. So that's the reason why we recommend them 10 business days. But then again, it all depends upon client to client. Everyone's situation is different.
Okay, very good. You answered my next two questions as well, and let's dive into that a bit deeper with you, Gaganji. Is that so? When you say when someone wants to find out how much they can borrow, do I understand this correctly? Then, if you've done the homework in terms of if you have all the information, you can probably tell them an estimated or an approximate amount, even if they don't have a pre-approval, they could potentially get a number in mind in terms of then using that to go and search. Is that right?
Yeah, that's right. That's basically what our job is. So our
Okay.
job is actually to do the calculations for the client. Again, it depends upon the advisor. I'm not saying that we are the most experienced ones. We have been in this market from last 12 months. But again, given our business banking and banking experience, we are pretty comfortable. So if we give someone a figure and we back it up. So our job is not to gather last 3 months bank statements, last 3 pay slips, put them into a folder and send it to bank, and then wait for bank to come back and tell us the figure. So we do all that work, and then accordingly we present that figure to the client, and then at least clients know that there is no point if clients can only afford 700,000 and they're looking for $1 million loan, because it will not work. So clients are wasting their time, they're wasting real estate agents' times, mortgage advisors. We are working for them, but when there is a huge variance in the figures, the deal will never work. So it's our job to provide our clients with the best option, obviously in terms of how much they can afford. So once their deal is accepted, it's presented to the bank, it's approved by bank, and then we have to, again, it's our job to explain them which bank or which products are better for them.
Okay, brilliant. And so is there a rough rule of thumb in terms of lending capacity that the banks generally approve, or is it very specific and unique to, of course, each person's circumstances? And what I mean by that is if your annual income is X, then the bank give you anywhere between, is there a number 4 to 8 times of your annual income or something else? And it's just a random sort of number that I've thrown there. But is there a rough rule of thumb that you generally would tell clients, or how is that calculated specifically?
No, so I would like to answer that, Baki bhai, with an example. No second person or a third person situation is similar or same like the first one. Even though in our banking world, when we dealing with multiple clients, we have seen even a person with a smaller income able to afford more than a person who is earning double than the first person. So I'll just give you a rough example, just to give you a rough idea.
Yep.
So we had a client X, who wanting to buy a property for 1 million, and they had a deposit of $400,000. So technically, they just wanting to borrow $600,000 from the bank. So when you look at this, you will, in your back of your head, you will simply think, yeah, that's pretty easy. They have already $400,000 deposit and 600 just to borrow from the bank. And good thing is also they are earning around $250,000 a year income. And then you will say, wow, that's a sweet deal. It's a vanilla deal. I can make it work with flying colors. But I'm telling you, their loan was declined.
Oh, wow. Interesting.
And I'll tell you the reason, because
Mm,
they got 3 kids, and 3 kids was they taking the private education, and they
mm,
were spending $30,000 on each kid on yearly income. So that $90,000 as an expense just gone like that. So it's
mm.
also depends upon your lifestyle. What do you have in your plate? So if your income, you're earning $250,000, and the residual income left after the month is just $1,000 just to survive on bread and butter, and I don't think so that's enough to for the repayments. So every person's situation is quite different to the first one. So hence we can't apply a general rule of thumb to everyone's situation.
I think that's a brilliant
And
example. That's to me, that's shocking. In fact, in terms of, I think a very good example of what is or is not achievable. Yeah, sorry, Gaganji, you were saying something.
yeah, and so I'll just probably jump in and share something that is probably relevant to your clients, Bakiba, because you're an accountant. Obviously, you deal with most of the clients who are self-employed. And point that I want to cover is when we talk about pre-approval, or we are using self-income from the businesses to get an approval, every lender looks into it in a different way. Easiest application to get an approval for is someone who's husband and wife working full time. We just use their last 3 pay slips, or we can use their 12 months IID tax summaries. But the challenge is with someone who is self-employed person looking to either get into first home or an investment property. So we have to go through their balance sheet, profit and loss, to understand what their business is actually doing. There are a number of add backs which we can add back, basically, in order to make the servicing work. But then at the same time, as Mandeep said, like Mandeep used an example for someone who was using most of their funds for personal use. But when we are talking about self-employed people, so we have to go through what the balance sheet looks like, what sort of debt, short-term debts, asset finances, business loans, business overdrafts they have got. So that actually requires a full assessment again. But then what a few times we have to rely on last 2 years financial accounts. Time to times the deals that we have done, we had to get the year-to-date accounts. And with our other self-employed clients from transport industry who are like, we've got a number of asset finances, we had to use their forecasts as well. So to answer your question, the answer is like everyone's situation is different.
Yeah, I think the I keep telling this to my clients as well. And when it comes to tax advice, when it comes to loan approvals, no two cases are really the same. And you've explained that really well with a couple of examples. And so when it comes to self-employed people, because I fall into that same category, and I know I've had challenges in getting a loan at times because of it's fluctuating income sometimes, right? In terms of you don't have a set salary in place, but
Yeah.
also because when you have a business. Let's dive into that a bit deeper, because a lot of situations, a lot of whether it's my clients, and I know a lot of people out there, they say they might be working a full-time job, but then they also have a side hustle in place, and it could be small, it could be big. How do banks, or how do you assess their situation then? Because this is almost like a hybrid situation where the self-employed, not fully, partly, but then they also work full-time. How does the bank look at that?
One of the biggest question, Bakaji, I would like, what banks normally use this term is called sustainable income.
Mm,
So this is one of the biggest thing what banks normally ask in their policy. Is the income sustainable? Obviously, nobody knows the future. Even a self-employed clients business can go down tomorrow, right? So nobody knows. Same with the PAYE employees. They can get redundant or the company can close. But what we need to assure as an advisor, and we need to discuss this clients, how they see in next round. Do you think something is happening in their business? There is going to be a material change in their income. But answer to your question, yes, as long as the income is sustainable or is generating income, then 100% each and every dollar will be used as an income for the borrowing capacity.
okay, brilliantly
Yeah.
explained. Thank you. Yes.
And for me, when we have got this sort of scenarios and simple words, it just needs to make sense. So whether you're applying for a home loan, or whether you're buying a business, you're applying for a business loan, or whether it comes down to a business having cash flow issues, they're needing overdrafts or business loans for business
Mm,
purposes. What the deal that we prepare for the banks, it needs to stack up and it needs to make sense. So
mm,
what I mean by that is you've got husband working in the business, you've got wife who's working full time. And then over the years, we have been presented with the plans where the business is not performing or not generating the profit that it's supposed to. So they present us data from last 2 years. And as an example, the business is showing loss in last 2 years. And then suddenly we are presented next 12 months forecast where they're showing a profit of like, say, 250,000. first of all, we need to understand, okay, from last 2 years, you have been making loss, but in next 12 months, you're going to generate $250,000
Yeah, how
profit.
is that
How?
possible?
Yeah, so it needs to make sense, right?
Yeah, it makes
Each and
sense.
everything, we're not saying that it will not work.
Mm,
It may work as
mm,
long as we can get our head around, like they're making significant changes in their businesses,
mm,
or yeah, we just need to understand what their plan is,
mm. And so
how
you
they're
mentioned
coming up with this deposit. Yeah.
yeah, no, that's a really good point. It needs to make sense, like logical, because a business that suddenly is loss making, that suddenly has 250,000 of profit, how does that, what's the business sense in that, or how has that worked out? Because there needs to be a logic to it, right? And one of the things you mentioned just before this was sustainable income, right? Am I right in understanding that the reason banks want to see a sustainable income is because they're, of course, interested in managing their risk, and then they want to see, will the borrower be able to service the loan? And that's why they look at that. Is that right?
It's not just that, Bakij, it's not just that the borrower will be able to service the loans. Banks are actually working in favor of clients. And this is what we have learned from the corporate world. At the end of the day, obviously, banks are lending us money and charging the interest. Obviously, that's a kind of business that they are running. But at the end, banks also wanting to see that we don't want any client falling into a hardship. This is one of, so what's the point? If you're earning $1,000, then $990 is going to your repayments, and you only got $10 a week left for yourself. That's not how you're going to survive. So banks doesn't want to do that. So that's why they are borrowing calculators, they are borrowing capacities, all planned or all lined up for a borrower to understand that how much he can maximum afford, the property he can buy. Obviously, banks are there willing to help to go onto a property ladder. But on the other side, this is the risk they also want clients to be aware of. We don't want you to, so that's why the sustainable income term is really important when they are taking into consideration that we want, if your income is sustainable, so we don't want that tomorrow you get redundant or something like that, or your business fails, then there is the repayment is going to fall back on you, or you're going to potentially fall into hardship. So all your dreams are going to basically will be destroyed when you buy a house and then suddenly you have to sell. You might lose your deposit because you sell it at a lowest value. So these things are designed in a way to benefit the clients for the biggest interest for the customers here.
Mm.
And
I think it comes down
banks,
to responsible lending, isn't it? I think you raised a
Correct.
very good point. Yeah. The one of my personal examples of someone who I know, there's sometimes within the community, within our clients, there's this big FOMO, fear of missing out, and then they think, no, we have to just buy a property at any cost, at any sort of, in any way possible, right? That they really stretch their limits in terms of the borrowing capacity, in terms of what they can afford. And then if property prices go down, and how we've seen that over the last 12 months and what's happening right now, where while it's a good buyer's market, but people are now forced to even sell because they bought it at maybe a high, and so it's a difficult time out there at the moment, isn't it? And
yeah,
am I right that this is why banks do their test rate is usually higher than, for example, if the mortgage rate is, say, from a bank is 6%, for example, would they then test maybe at 8% or something? And is that why they do that, to test that if the interest rates do go up, can the person still afford the repayments? Am I right there?
yeah, yeah, spot
Correct.
on, spot on. That's exactly what the test rates are designed for. Like even now, with the decrease in OCRs, banks have slightly reduced their test rates, but they're still around 7.60s, 8% here. So I think it's in the range from 7.50 to 8.15. And I'll just add on to the Mandeep's last point. So because we have come from the banking background, so we're not only talking about one particular bank, but now we deal with all the banks. We can put our hand on heart and say all the banks have actually got very good processes in place to ensure that the homeowners are protected. So they do the credit process that is in place is actually to ensure that the homeowners do not end up in a position where they cannot actually afford to make repayments, because the banks actually are in the market to sell loans, not homes. We need to understand this
Very
different.
good
Their
point. Yeah.
businesses, yeah,
Mm.
they want to do more loans, so they have got good clients with them who get into first property, then property investment, then businesses. Like most, not talking about particular community, but most of us like to do well in our careers. That's why we are here. And you need to have a good relationship with your bank. That's the only thing which I can say. And banks are here to help us. We have seen clients who end up in hardship, and then again, banks have actually got proper teams, experts who actually hold the clients who are in hardship. They hold their hand and they guide them step by step. And we
Mm.
have seen actually people who go into hardship and then they actually come out of it just
Mm.
with the bank's help.
Mm. Yeah, I think you raise a very good point, because the each person's situation is unique. Just because X has bought a property does not mean it's the right decision for you. Maybe you can afford it, maybe you cannot afford it. And property really, or home ownership, it's a long-term game as well, in terms of you need to look at it over a longer period of time rather than a short-term period, and see whether it's sustainable, whether it's the right decision for you, can you afford it or not. And so a number of things to look at, right? I want to talk about also investment properties. A lot of my clients are people who already own an existing home. And so I want to talk about that. But before I jump into that, one last question on homeowners and first home buyers is, so if someone is looking to buy a property in the near future, what is the best time to engage a financial advisor or a mortgage broker? Because I think you mentioned earlier it takes at least 10 business working days for an application to be processed. There's no pre-approvals in place at the moment, especially if you have less than 20% deposit. So generally speaking, what is then the best time to engage with someone like yourself, for someone who's looking to buy?
There is no right or wrong time. It's just basically whenever it suits the circumstances. If you've got someone who's looking to buy a property in April, they can literally touch base with us now. At least we will be able to have the conversation, understand who they are, what they do, and then guide them accordingly. So sometimes it's not all about buying a property tomorrow. There is a lot of work that goes in the preparation. So you can start that preparation piece basically from whenever it suits you. So it's just a matter of picking up a phone call or email conversation to understand that, look, this is where we are. What do we need to do?
Yeah, but it's not like if I want to buy a property in 10 working days, that I'll then approach you today, right? That's probably a short period of time, isn't it? In terms of
Not with someone is going to buy property in 10 working days. So basically, it's going to be a bit of challenge. And we have done it. We have got recent applications where clients come to us and say, hey, congratulations to me. Here's a sale and purchase agreement. I just signed a property. And I was like, okay, you haven't even given me a single document. Yeah, I'll do it everything tonight. So basically that is a kind of, we love these kind of challenges, to be honest. And not that we propose this to everyone.
I would have a mini heart attack there if it happens to me.
No, but I think because this is your life-changing decision, this is actually your milestone. So we actually request everyone, so make sure you complete your due diligence. Make sure you talk to people, not just that your friend just bought a property and then this is your time now. No, your circumstances might be different. Please do your proper due diligence. And when you're actually jumping into it, please talk to some professionals, not just talk to your friends only, but some professionals as well. Gagan got a really good example of someone who was saving money into Kiwisaver, and I will definitely request him to share that with your audience. But yeah, like you mentioned, that if someone just signed a sale and purchase agreement and only got 10 days, then absolutely, because it's not just our work, it's the client's work as well. They need to provide us each and every single document on the same day. So we will prepare everything on the same day and submit to the bank on the same day. So at least the application will get picked up in a timely manner, and then we will get an approval.
That's quite impressive. I've, to be honest, never heard of that same day. And so if you can do that, I think that's amazing. And it's good to know. We'd love to hear I'd love to hear your story, Gagan, the example that Mandeep is referring to.
Quite a few. I'm just still, we are in different offices and it wasn't planned. So I'm just trying to remember which one is he. But I think I know which one he means. But now, Bhagabhai, as Mandeep mentioned before, yeah, we just work according to our client's need. If someone wants to, if they have got their offer accepted, then our intention is to get that application with the banks within 24 hours. We don't hold on to the applications because banks takes their time. But again, the good thing about working with professionals is that when professional, it's not only the financial advisors or mortgage advisors, it's their accountant, it's their lawyers, it's the valuers. So professionals are there for a reason. So you need to take the advice from the professionals rather than your friends. So I had a scenario where, because banks minimum, if someone is looking to buy a property, one of the main thing which bank looks for is that they need to have a genuine savings, 5% genuine savings. And so that can't be a gift or a loan or whatever. Help from family, so it needs to be genuine savings. It can be in your Kiwisaver or it can be a separate amount that you're saving every week, fortnightly, or monthly into your savings account. So they need to see the proof of it. So at this couple who were looking to get into property, they had awesome dreams like everyone that they need to get into this property around $1 million range, both of them earning good salaries. But the only issue was that rather than saving into their account, they were contributing I can't remember exactly, recall 8 or 10% into their Kiwisavers because they were hoping,
8%, and plus they were making extra lump sum payments also. They were saving 8% and extra lump sum payments to their Kiwisaver as well.
So did
because
that
one of their friends just told them.
Yeah,
did,
the friend
did that help them?
Oh, that was the plan that it will help them, but it didn't.
Oh,
because
really?
Kiwisavers. Yeah, because that all those funds were in Kiwisaver. So anything, what we picked up a conversation with them after, I can't remember, 2 or 3 weeks, and then they were a little in shock. And then they said most of the balance from the Kiwisaver is wiped off. And I was like, what do you
Oh, I
mean? Because
see.
yes. And then whatever they were saving for the first time, they were hoping to withdraw that within 3 or 4 months, 3 months, I think. And yeah, all that
So because the Kiwisaver balance went down, they
went
Correct.
down. Exactly, because they were advised by their friend to do that. Clearly, if they would have gone out and spoken to a professional, the professional would have told them or advised them that if they're looking to get into their first home within 3 months, then they need to be, rather than being the what they call the growth, rather than investing in the growth funds, they should be investing in the cash or conservative funds where the risk is low.
When it comes to Kiwisaver, I have a very opinionated view on that. I won't go into probably the details. There's a lot of course, positive stuff about Kiwisaver, but my own example
Exactly.
was that when it comes to Kiwisaver, I could not withdraw my Kiwisaver, very similar situation, because I hadn't completed my 3 years within
3 years, yeah.
a Kiwisaver. And then also I ended up building my home rather than buying my home. And so they're like, oh, you don't qualify because you've built your home. You've taken an out-of-box approach there. So, but the other, I took a very different approach to getting into my first home. But I think when it comes to Kiwisaver, there's a lot of you need to know, I think, and get that advice upfront, plan for it properly. And again, Kiwisaver is again a long-term thing, right? It also depends on
It's a
whether
long
you're
term.
in a conservative, balanced, aggressive fund and so on, right? Very
Exactly.
interesting story there. Okay, let's talk about investment properties and someone who have existing homes and who's an existing homeowner. So a lot of clients I deal with, they are someone who already own a home, whether it's a house, a townhouse, an apartment, whatever that is, and they are looking to buy an investment property. So some common questions that come up, which I'll put to yourself, and are these. So firstly, is it true that someone who already owns a home, they then potentially do not need to have another cash deposit in place to then buy an investment property? Is that true?
No, that's not correct. Definitely, as long as they have equity available in their existing owner-occupied property, then yes, that equity can be utilized. But again, we need to think from a perspective that equity doesn't come up like a cash. It come up in a form of a loan. So bank will convert that equity in a form of a loan and will give it to you to buy the second property.
Okay, so let's take an
So
example here. So
yeah.
Yep.
someone who owns an existing property, say they bought it for 600,000, right?
Mhm.
And say the current valuation is 800,000. Can they withdraw the equity of the 200,000 from the property? Or how does the bank calculate the usable equity there, which can then be used as a deposit for the next property? Could you explain that?
Sure. So how this works is because Reserve Bank has set up a limit, which is that minimum collateral or equity requirement or the cash deposit requirement is 20% of the property value, right? So let's say if your property is worth $800,000, that means as per Reserve Bank, you need to have $160,000 as your collateral or your equity or your cash deposit, right? Now, again, if what would be the loan balance? Let's assume that you got a property worth $800,000 and you got a loan of $500,000 outstanding balance, right? So what do you need to do is you need to basically take 160 out from that $800,000 property value, and then you minus the loan value, which is outstanding balance, which is $500,000, and the amount left, which is $140,000, that is your equity available on your owner occupied property. Bear in mind, 20% requirement is for owner occupied properties, whereas investments, you require 30% deposit and equity.
It's 30% now, is it? I thought it was 35% up until
It's
recently.
30% now. Some banks
30%,
are
yeah.
still taking 35, but it's the rule of thumb is currently
Okay.
30%.
So if I want to put it another way, and correct me if I'm wrong, please, here, is do I understand this correctly? Say that in other words, if you have a property that's valued at 800,000, the maximum that the bank can potentially lend you is up to 80% of the value of their property, because the 20% you still need to keep within their property as equity.
Yep.
And this is for owner occupied properties. Am I right?
Correct.
Okay.
Yes,
And
that's
then
right.
if you're in,
There are some
sorry,
exemptions.
yeah, go on.
Yep.
Sorry, there are some exemptions. If you're if you already own a property and then you go to bank and you say, look, I want to buy investment property, then yes, you need to have minimum of 20% equity in your owner occupied property. But if you go to bank and you need funds, there are some exemptions where bank can actually lend over 80% on an existing owner occupied property. And the example of the exemptions are like someone who wants to do, if there are any issues in the property, like structural renovations. And there are a couple of other ones where bank can actually go over 80% and do a home loan top up for the owner occupied. But yes, to answer your question, if someone is looking to buy investment property, then they need to have a minimum of 20% equity in their owner occupied home.
That's interesting. I did not know that in certain circumstances and exemptions, you could potentially go above that.
Yeah,
An
you can.
example you gave was if there's existing on your existing property, if there needs to be some work done on that, for example. And
I won't go into much details of that, but just for you and the audience, when I
yes.
was a lender at BNZ, I actually funded one property at 96% LVR.
Wow. Okay.
And please
So
don't ask me what
96.
was the reasons. Yeah. It doesn't
I
happen in
won't
real
ask you
world at
the
all.
reason. So up to 96%. So for example, if the property is valued at $1 million, for example, the bank was theoretically able to lend 960,000 as a loan, is it?
There was, it was a housing and a construction, and things didn't go the way they were supposed to.
I
Yeah,
see.
rather than having a half incomplete property, so we had to go out of the way to make that work. But as I said, it doesn't happen in the real world. Yeah.
I see. Interesting. And so that's for owner occupied we discussed. So if someone's then looking to use the existing equity, and that's not an owner occupied property, but they want to leverage off an existing investment property that they have. And so then do I understand correctly, then instead of the 20% that they need to keep within that, the property as equity if it's an investment property, it's increased from 20 to 30%, and then the bank will only be able to lend you up to 70% of the value of an investment property. Do I understand that correctly?
That is correct. And that is used for an existing dwellings. That means the properties which are already built. Now, again, as Gagan mentioned, there are some exemptions in place. So as New Zealand still require a lot of houses to be built around. So for new builds, some banks are even doing around 20% minimum deposit, even for investment properties.
That's interesting. So then the 30%
new
LVR
builds.
does not apply. So it's only for new builds. Interesting.
Yeah, that's where LVR exemptions apply because it's not an existing dwelling. So for investment some banks can go with 15% deposit, some can go with 20% deposit as well. But again, that's case by case scenario. It's not a general rule of thumb that it applies to everyone. So it depends upon customer current financial situation as well. And also and that's really taken down into a key consideration. For example, that you are not a homeowner and this is your first property, and then you're looking to buy and you're looking to convert that an investment property. You need to have a really good understanding that what's happening there, why we are doing it. Then banks can literally ask, are you going to generate income out of it? So are you treating it as a business? But we don't go deep into that. It's not a single general rule of thumb. So it's quite a variation depending upon case by case scenarios.
Yeah, again, a couple of months ago, we did put in a post on our Facebook page where we were able to get secure a loan for an investment property, new build with 10% deposit. So it's all case by case. Whatever we have talked about, 20% for owner occupied, 30% for investment properties. These are the restrictions that are currently in place. LVR restrictions currently in place, but then there are some exemptions to it. Again, we can spend, every deal is different. Wherever there are any questions, happy to pick up a conversation. Yeah,
it's interesting to me that the banks are willing to lend more for new builds. Because for me, because I'm an accountant, I always think for new builds when it comes to there's this whole strategy for in terms of buying, and there are certain benefits of buying an existing property or an old property, because you could or if you do some renovations, you could potentially add some value, or if there's a bigger piece of land, it's a land that goes up in value. So it comes down to your overall investment strategy, isn't it? And so with new builds, one of the issues I personally have is that the potential for the value to go up further is sometimes, of course, it depends on the property, can be limited. But it's interesting to know that the banks are willing to, they look at new builds more favorably, and is maybe one of the reasons because they have lower maintenance costs and they're just new builds. So there's a better, I guess, confidence in terms of the structure of the property and then the rules that go around that, master build and other things. And so is that one of the reasons, or why is it that banks look at new builds favorably?
It's implied by the government, by RBNZ. So this is RBNZ policy.
Yeah, it's not the banks. Yeah.
Okay, I see. So it's a set by. Okay, interesting. Okay, so we talked about LVR, right? There's a lot of talk in the media, LVR, but I don't think everyone understands maybe, or let's offer the benefit of those who are watching this. What does LVR mean? And can you explain that in sort of simple terms for someone who doesn't know much about LVR?
Yeah, LVR stands for loan to value ratio. So basically the formula is loan amount divided by property value times 100%. So to break it down, someone is buying a property for $1 million. They've got a deposit of 10%, which is 100,000. So 100,000 deposit, loan amount is 900,000. So to calculate their LVR, it will be 900,000 divided by million into 100. So the LVR will be at 90%. Anything that I missed, Mandeep?
Yep,
Just
correct.
doing the numbers at that time, same time. Okay. So yeah, the LVR loan to value ratio will be 90%. So they have got 10% equity in the property. So if this guy was making $150,000 deposit, then 850 divided by $1 million, which was the property value into 100, it's 85%. Loan to value ratio is 85%, means they have got 15% equity in the property.
And so who sets the LVR? Is it the Reserve Bank, is it? Or is it the
RBNZ,
banks
Reserve Bank of New Zealand.
Okay.
And the other thing that LVR dictates is the interest rates. So if your LVR loan to value ratio is less than 80%, less than 80%, LVR less than 80% means that you've got a 20 or more than 20% deposit in the property. You get favorable interest rates. You get the best interest rates. As soon as the LVR goes over 80%, you don't get those interest rates. In fact, there is a margin added on top of the loan. And the margin, again, is dictated by what the LVR is. If your LVR is over 85%, you pay more margin than someone whose LVR is 82%. So there are brackets below 80%. And then the second one is 80 to 85% LVR. And then the third one is L 85 to 90. There is 1 plus 9. There is another one which is 90. Greater than 90% LVR on a swap, where you end up in literally paying 1.15 margin on top of the advertised rates. So again, there are different brackets.
So then does that mean that if you want the best interest rates, meaning as low as possible, then it's probably a good idea to have as high of a deposit as possible?
Yeah.
20%,
That's
yes,
right.
fully owner occupied.
Okay, so at least say 20% if you're owner occupied, and if you're not, and then you get charged. And do I look at it as it's like an equity premium or a risk premium that's added then?
It's called low equity premiums or low equity margins, you would say. Some banks call it LEM, some banks call it LEP.
Okay. I think we're down to the last couple of questions and then we'll close it. I think this is going really well. And I'm conscious we've actually gone over time, but I still have maybe a couple of last questions and before we wrap up. So say, what's your advice to someone who wants to buy a property and they're not currently either getting enough from the bank for the type of property that they want to buy? What's your one piece of advice for them? What can or should they do then?
I would probably start with this one. So if someone is looking to buy a property, not sure where to start from, or depending upon which stage they are at, they probably need to, again, go back to what we talked about before, get in touch with the professionals, whether it's us, the bankers, accountants. What I mean by that is there are a number of related back to what we do. There are a number of mortgage brokers or financial advisors out there, but you need to do their due diligence. The clients need to do their own due diligence to find out like who probably will be the best suit for them. Because there are two types of advisors. You can literally do a level 5 course and become an advisor, or you can literally spend 10, 15 years at the bank, then do the level 5 and become an advisor. One thing, you can buy literally anything. One thing which you cannot buy is experience. So you need to have the right type of advisors around you who can advise you on what you need to do.
Yeah, absolutely. I think that's a very good sort of piece of advice there. And can you tell me what banks do you currently deal with? Or let's put it in a different way. This question is, what is the difference or the benefit of someone coming to you directly as a home and loan advisor or a property, whether they want to buy their own home or maybe buy an investment property? What's the difference of someone, say, coming to you directly versus them, say, going to their existing bank for that person? And can you also answer this question in the line of also maybe do you only deal with first tier lenders or maybe also second and third tier lenders? So there's two parts to this question.
I'll answer all in one for you, Bakir. So there are more than 31 institutions or lenders out there in the market, which includes first tier, second tier, and third tier lenders. Okay, so and most of the housing lending that falls under CCCFA, Consumer Contract Act, which is regulated by Reserve Bank of New Zealand. So all these lenders are regulated by that. Okay, and when you ask me the question that shall they come to us or deal with different bank, Again, it depends upon the choice what the clients have. However, if they approach us, we will be able to share our experience, and based on our experience, we will be able to guide them in a professional manner. And also, we will have an idea that which bank they fit more favorably, rather than just them personally going out and applying with A, B, C, D, or C, or different banks, and filling out their application forms and finding the person and spending 10 to 15 days each with each bank. So it's going to be a really mind-boggling exercise for them. But rather than doing that, they can simply get in touch with us, and we will be able to give them rough ideas, rough figures, and we will be able to guide them with what bank they will be able to secure their lending with. And the other thing which I would like to basically give you a bit of rundown also, our advice is generally free because we get compensated by the banks after we have a successful lending taken out by the clients. Obviously, so it takes a lot of efforts and a lot of commitments, not just from us, but from the client itself too. So clients needs to be committed that yes, they are genuinely looking to purchase property. So we will put our more than 100% into it to advise them to the right path, so to fulfill their home dream. So that's all I can say about that.
Okay, the way I look at it is that instead of going to just one bank, and this is maybe again an awareness and educational issue that comes up, is some people might think that, oh, because I'm banking with, say, just an example, say ANZ, I can only get a loan from ANZ. But that's not true, isn't it? You could potentially go to
No, it's
another
not.
bank or another lender, isn't it? And if you go to one bank, you're restricted by that, versus if you go to a financial advisor or a mortgage advisor, then you can potentially look at, it's a bigger net that you are casting it over, right? And then the second thing, as you mentioned, is you don't charge for your services, generally speaking, because you get paid by the bank. I think those are some two really good reasons why someone should approach a mortgage advisor, and of course your experience and comes into play. So I think those are really good points. And how can then, and probably this is then my last question, and then we'll wrap up. Let me know if I've missed out on anything. But I would encourage to anyone listening to this, is if there's any questions that we've missed out on, then please maybe reach out to me, reach out to Gagan or Mandeep, or put this, and we'll upload this to the YouTube channel, is put them in the comments, and then maybe we could do another session or another round of this at some point in the future. But my last question to you then, to both of you, is, so if someone does want to reach out and have a discussion with you, Gagan and Mandeep, what is the best way for them to do that? Could you please let us know?
Yeah, definitely. First of all, again, we would both like to say thank you to you, Bakir, for arranging this. Really, we have covered off some very good questions, but one thing which we have just focused on in today's session is home lending. But one thing for us is that's not the only thing we do. As I mentioned before, we specialize in home lending, we specialize in business, commercial, and we are accredited asset finance brokers with the main banks. So if someone likes for self-employed clients who are looking to expand their business vehicles, they're looking to whether buy a new ones or whether looking to refinancing their existing, if they're paying higher rates, they can get in touch with us and we can do a free assessment, exactly like home loans. We can help them to save money on their vehicle loans. But the best way to get in touch with us is through our mobiles or our emails, which we will, I'm pretty sure there as a way where you will be able to edit and post our mobile numbers and emails on
I'll put
YouTube.
this in the, yes, in the description of the video and also in the comments section. Yes. Yep.
Yeah, please. In the next sessions, we would like to take the opportunity if we can focus a bit more on the business, commercial, and asset finances as well. But we will share our contact details
Sounds like
with
there's
you.
another session which we'll do soon on specifically talking about that then. Yes.
Exactly. Yeah. So our website is www.gmfinance.nz, and we'll share our other contact details with you soon.
Okay, brilliant. Thank you very much. I would like to thank you for your time once again, Mandeep ji, Gagan ji. I think an absolute pleasure talking to you and taking out the time to be able to share your insights and knowledge with the sort of rest of the community. I will definitely stay in touch, and I think it's been a wonderful discussion. Thank you, and I'll see you next time, hopefully for another session on these other topics. Thank you very much.
Sounds good.
Thank you,
Really
Bakir.
appreciate it.
Thank
Thank
you.
you.